Hello everybody, it's Tortoise Investing coming at you today with another 5 dividend stocks that you can buy and hold forever. If you're new, hit that subscribe button. Let's get that march on to 1,000 going. Make sure to hit that like button and comment down below. Doing all those things takes just a second, and it really does help out the channel a lot. That YouTube algorithm is a tricky one. Either way, let's take a look at what we're going to be taking a look at today. We got Dollar General, we got Canadian National Railroad, we got Discover Financial, Next Era Energy, and Crown Castle. If you came for the list, thank you for dropping by. If you want a deeper dive, let's go ahead and dive in a little bit deeper. So Dollar General, they got a low adjusted free cash flow yield right now. They are having a tough time this year so far. So just at 0.04%, their dividend yield's 1.41%, and their payout ratio is 21%, so no issues there with their dividend. Let's take a look at the revenue over the last 10 years, growing at a rate of 8.98%, so very nice. As you see here, they have that little dip in their free cash flow. Up till then, it was going very nicely up and to the right. But again, they're kind of having a rough year so far when it comes to that, which explains this big drop-off down over 32% on the year. I think this is probably a really good entry point. None of this financial advice, just showing you some deals that you might be able to do a little bit more research and look into for yourselves. So EPS continuing to grow at a rate of 14.1% over the last 10 years. The dividend has been increased at a rate of 15.26% over the last 5 years, so a very nice little compounder. They do got some debt at $5.72 billion, but their EBITDA is $4 billion. No issues there whatsoever. I don't like a company to hold 3 times more than their EBITDA in debt, and this is definitely nowhere near that. The share count is something that has been dropping in recent years, almost at 5% over the last 2 years, and right at 3.8% over the last 10 years. So I do like companies that buy back their shares. I do believe that they said that they're going to suspend their buybacks right now and try and get their cash flow back in order. I'm kind of like, when it comes to that, because I like companies to buy back cheap shares. That's such a big thing that I like to look for. But I mean, I don't have access to all their everythings, so they've been doing so well so far, so I trust them. The return on capital employed has slowly been decreasing over the years. Again, still above 10%, so not bad whatsoever. Next up, we got Canadian National Railway Company. A lot of the railroad companies and stock holdings have been taking off here the last little bit. This one, is still right there where it's been pretty much all year. It's kind of been hovering around this 124 to 112 zone. They have an adjusted free cash flow yield of 5.38%, a dividend yield of 2%, and a payout ratio of 49.7%. All check marks for me right there. Revenue over the last 10 years has been increased at a rate of 5.6%. Not too bad. Free cash flow increased at a rate of 11.41%. You gotta love that when they are cash rich. See if there's any stock-based comp. Nope, not an issue there whatsoever. Very nice. EPS has been increasing at a rate of 9.27% over the last 10 years. Growing EPS, growing free cash flow. Check marks for me. The dividend has been increasing at a rate of 11.01% over the last 10 years. Another check. And they have been doing share buybacks over the last 10 years at a rate of 2.38%. Looks like I've been accelerating it over the last year at 3%. So again, very nice. And the return on capital employed is growing from 11.5% up to 14.6%. So Canadian National Railroad, you're looking for an industrial, looking for a railroad stock, might be something you want to dive into a little bit deeper. Next up, Discover Financial Services. This one did go on a little bit of a run here recently, right up to 121. Then their earnings came out and it dropped 10%. Just a free cash flow yield of 29.19%. They got a dividend yield of 2.39%. Don't know why the payout ratio is not showing here. I think their payout ratio is somewhere in like the 20s, 30s, something like that. It's not high whatsoever. Revenue. Let's take a look at the revenue over the last 10 years. Growing at a rate of 5.71%. Very nice. Here recently, it's been increasing at a rate of almost 10%. Very good. Free cash flow has been increased. I read 9.07% over the last 10 years. Take a look at the comp. Not an issue whatsoever. EPS has been increased at a rate of 12.24%. Growing revenue, growing cash flow, growing EPS. I like it. Dividend also increased at a rate of 13.35%. Very nice. They've had some nice little big hikes here recently. Great compounding. Their debt is $20 billion. Their EBITDA is 8.17. So again, no issues there whatsoever in my eyes, personal opinion. They haven't been buying back shares, which, I mean, that's okay. And the return on capital employed, they are still struggling from the 2020 oof that a lot of companies, even still yet, 3 years later, are still just struggling to get everything in line. But DFS Discover's a pretty good little company. I like them. I think Warren Buffett owns it, so again, might be something you want to look into a little bit further. Next up, NextEra Energy, one of the very few utilities that I like. When it comes to these, you're gonna see low cash flow. You're gonna see a lot of debt. But that's just how utilities work. They're kind of like zombies. Like, they take out debt to survive, but they survive. And that's probably a weird way of saying it, but that's very true. It's how they work. Dividend yield 2.6%, payout ratio 51.7%, so no issues there. Revenue has been increased at a rate of 3.9% over the last 10 years. They have negative free cash flow. Again, you're going to see this with almost every utility. EPS has been growing slowly at a rate of 3.76% over the last 10 years. I think that has something to do with these hikes here, because if you do look, it's not bad. It's going up and to the right over time. The dividend's been increased at a rate of 10.99% over the last 10 years. Very nice. They beat on their earnings. They beat on the estimates with their profits, and I think that renewable energy is the future. So this is a big future play. This is something you're getting in now. You're going to let this sit for a decade or so and just reap the benefits, because this has been beating the market. I think I read a thing over the last 20 years, it's beaten the market 17 or 18 times. So, I mean, it's reliable. It's a great utility company. Utility companies are usually pretty safe. This one, of course, is beaten up because of the increase of, them having a lot of debt and interest rates just going through the roof. So once that's resolved, I think that this will absolutely take off. Again, personal opinion. And lastly, we got Crown Castle. This is a REIT. REITs are taxed differently, so as always, make sure to do your own research into these before investing into just whatever. They have an adjusted free cash flow yield of 3.42%. They got a dividend yield of 5.69%. And when it comes to the payout ratio, these are from FFO, from their funds from operations. And if you look at the free cash flow, they're probably okay. Alrighty, so Crown Castle, the reason I chose them over American Tower is they are down more. Both of them are great REITs in my eyes. This was a recent high at the end of 2021, over 200, and I think it's over 200, wasn't it? Yep, over 200, down to 111. So it is beat up, down almost 20% on the year as well. Now let's take a look at this sucker. This is Cell Phone Tower REITs. Over the last 10 years, revenue's been increasing at a rate of 11.13%. Very nice. Free cash flow has been increased at a rate of 16.82%. Again, very nice. You'd like to see that. Dividend has been increased at a rate of 8.31%. Very consistent and a great compounder. I like them. The return on capital employed, it's growing, but it's a REIT. It's a REIT. We're not going to pay attention to EPS or anything like that. They have been doing a little bit better here recently. They are going to be, I've seen here, they're going to be slashing about 15% of their workforce. So what that's going to do, that's going to make their revenue and their free cash flow count more. They're going to be able to make a little bit more money. Doing layoffs is always a terrible thing. And I mean, it's been like that for the last year. Like, a lot of companies are having to do that. But yeah, that's 5 dividend stocks that you can buy and hold forever. I hope that you enjoyed that. As always, like I said, make sure to drop a like, hit that subscribe button for more, and until next time, see yous.